What's up, YouTube? It's Joe Catchpolia sitting on the couch, making some money, investing in fractional real estate online, as usual. Today, we're going to go over the Gruden, which is Mogul's latest listing. I am a few days late in getting this out. I've just had a lot of other stuff going on, so have not had the chance to do this. There is still plenty left, though. It's a pretty big raise. There's a lot of, big equity raise. There's a lot of money there they're going to need for this one relative to some of the ones that sold out quickly. And it doesn't look like too much has sold yet. So I think we have time, which is one of the reasons I felt like it was okay to just slack off. But anyway, I have no idea the name, the Gruden, where that comes from. If you know, please put it in the comments so that other people know if they're like me and clueless about all the names that they pick for stuff. So what is this? It is a short-term rental in Lago, Florida. If you look at these numbers, their year one yield 7.7%, average yield 11.6, levered IRR 12.7. These are quite a bit lower than what we've come to expect from them. If you remember, Mogul started listing these, the strategy, if it's core, if it's value add. What do they have? Core plus, value add. Why we say value add and core plus, where they're doing the plus each place. Anyway, this is something if you watch my last video about them, I don't really feel like they're using these in the way that I'm used to seeing core plus, and value add used. I would virtually never use core on something that didn't have a long-term lease in place. I mean, it seems tough to use it for this. But they're saying, okay, it's, in place income. It's a market that is well developed. It's a mature market. And so, okay, we're going to get a little bit lower yield here than we would get in other places. I think that's kind of what they have going on here. I can understand it. Whether or not you think it is a good risk adjusted return for you, right? To take something that's below their average deal. Does this feel like a safer deal to you than other ones you've invested with them? I mean, that's going to have to be, that's the decision I'm always trying to make, right? I mean, you have to, if I feel like I'm taking more risk, I want to get a higher return. And so typically when you have a core investment, it's very de-risked, right? Like I said, usually you have, long-term in place leases. I thought a lot about, okay, if I wanted to say, a single family residential investment property was core, if I wanted to put them into those categories, what am I going to find that actually fits for that? And I think, I guess part of it is they're just saying, well, we're taking it over, we're running it exactly as it is. But I don't think that's the whole thing, right? Like, at least when you use the same categories in commercial, there's a lot more that goes into it. And so, for me, I would want, a home in an established market. I think we have that, right? I'd want relatively new construction or a full renovation, right? You want very little maintenance or any, expected repairs to come up. I would want a long-term lease, right? And I'd also want to be, so like what I could picture a core investment would be a long-term rental in a class A type single family home rental market, assigned to good schools in a place with a growing population. Those sorts of things are what I'd be looking for. It's just really hard for me to justify when you have a short-term rental where you're going to have, fluctuating revenue, to put that into the core piece of my portfolio just doesn't make a lot of sense to me. I mean, it would be very hard for me to imagine that this is churning out, very stable returns over the hold period, which is what I expect from a core investment. Anyway, I think I've probably talked about that too much. This is just the nerdy me. I think I mentioned before, like this is something on the commercial side we think a lot about, right? Because when I worked on that side, I worked with a lot of different private equity groups, and people would want to place certain investments in certain types of funds. So you had core funds, right? You had that all they were looking for was a certain type of deal. And it had those characteristics, right? It was in a great market. It was in, it was a stable, predictable income was really the biggest thing. And so that's what for me falls down for this. But maybe you could say relative to the other short-term rentals, this would be a more core holding. I can see the argument for it, but I don't feel good about that. And I really just don't see wanting to take a lower return for this particular one, but we'll get into, some of the reasons why that is. Okay. Want to talk about the market. I don't think we've looked at anything in Lago, Florida, or Largo. I don't know why I was thinking it was Lago. I've been spelling it wrong when I've been searching for it. Okay, Largo, Florida. I should have known that. Okay, it's late. Sorry about that. It is, I think they said, the fourth or fifth largest city in the Tampa Bay market. It's, I looked up, growth rates, very nice growth trend here, right? It's not a huge city. It is a sub-market in the St. Petersburg market, actually, is where AirDNA places it, and I'll show you that market in a minute. But you can see, okay, great population growth here. That's a strong indicator of demand for single-family homes, not necessarily for short-term rentals, but I'm going to get into the AirDNA data on that as well. And so it's in Pinellas County, so I looked up the county data. It's had strong growth, but in the, from 2000 to 2010, it had a little decline. My guess is this is due to the 2008 financial crisis. Maybe not, but I know a lot of the Florida investments that I was familiar with really crashed harder than other places. And so, we had tons of empty condo projects and stuff like that. So maybe that's part of it. I don't really know for sure what was happening, but you can see for the last decade, there's been strong growth. And then, the last couple of years, we've had a little bit of growth too, but it does seem like, 0.3% over 3 years. Maybe that's slowing down again. I did look up the AirDNA market. I don't know why I haven't been doing this before. This is something that I've used when picking a market, and this is a fantastic submarket score. To get a 92, this is a really strong score. They rate it on investability, rental demand, revenue growth, seasonality, and regulation. You can see this is a pretty seasonal market, right? And I do expect that in Florida. In the email, they had said routinely average over 70% occupancy in this city. I don't know. AirDNA thinks it's 68%, and that's gone up. But we're not too far off from the 70. I'm not sure. One of the things, a lot of this data is not standardized yet, right? I mean, there's a bunch of different platforms that will give you data on this, on short-term rentals. Most of them are only taking Airbnb's numbers and sometimes Airbnb's and VRBO, but there are a ton of other short-term rental platforms. And so you will see quite a bit of change from one site to the next, depending on what info they're taking into account. But if you look at these, average annual revenue, $54,000, this doesn't look at all like our property, right? Well, let me go back to here. We're at 220,000 plus in revenue. So we're on the very high end of this particular market. I really like that. So at least in all of the markets I follow, the short-term rentals that do the best are the top of the market, right? It's the people who aren't competing on price necessarily. They're really competing on, it's just an amenities war is the way I think about it, right? They're just trying to have absolutely all the best amenities. And so this home seems to really fit that bill. The average daily rate's almost 4 times what this number is, which is, this is the market number. So let's see. I'm going to get into the individual AirDNA info in a little while, but this submarket score 92, I'm going to start including this in all the videos. So you'll be able to see over time, like, how does that stack up? But this is a good submarket score, relative to most that you'll see. And then I also looked at the Zillow home price trends, and over the last year, we had a big decline. But the projection going forward is up 0.4%. If you look, this is a similar shape that we're used to seeing with this home price trends. Although this drop off here is quite a bit more significant than we've seen in a lot of other markets, right? I think the last video we did, we were actually, that market had already surpassed the 2022 peak, and here we're well below it, right? So hasn't done as well, but it's, Zillow thinks it's going to move up a little bit for what it's worth. And again, this is talking about median home prices. This home is not the median home, right? I mean, if we have a pool, we've got a hot tub, we're right on the water. When you talk about amenities, you've got your own dock, you're right on the water. Really high-end finishes, I mean, this is the sort of place that makes me uncomfortable. This is not, it's too nice for my taste. Although this is kind of funny when you see, okay, I'm not sure that this necessarily fits the overall look, but yeah, this shower, I would feel like I'm getting this shower dirty if I used it, right? I mean, I don't know. They got the pool table, but they've really got all the amenities here. And so when I guess that's not, part of the home. So again, this median price point doesn't have a big impact on what we are expecting this property, but I mention it because it is, it's data that's out there. All we can do is really look at everything that we can. There's tons of free info online, and just trying to figure out, does this investment make sense for me, right? And so I'm trying to use all these different tools that I can. A couple of things. So let's see. This was listed. This is not an off-market deal like a lot of them that they have. This was listed on the market. Oh, can I close that? Oh, okay. Well, great. I lost the particular. Yeah, there we go. Let me just do this. Open that back up. Move my little face up that way. And I'm right back where I was. I don't know why. It just looked a little funny to me. But so it was listed at 1.35 million. We have it under contract, I think, at 1.265, and we do have an appraisal contingency at the 1.265. We have seen that when we've a couple times where the appraisal didn't come in high enough, that Mogul still moved forward with the purchase because they were able to use a little bit more financing and still maintain the numbers. So because of that, even though we have this appraisal contingency, it does make me a little bit nervous still. And I always want to look at, okay, what's the valuation? Let's see. And where did we have it on here? Is this one? A lot of these, oh man, do we not have it? I thought that I had found the Zestimate from before. Wow. You can tell I've just been, oh, here we go. Yeah. 1 point. So the Zestimate's just slightly above what we have it under contract for, but I think that's great, right? Because if you think about it, we're getting the home, but we're getting all the furniture, fixture, equipment. That shouldn't be, impacting the Zestimate at all. So I think we're doing pretty well on that. Redfin also, let's see where the Redfin estimate is. Yeah, 1.27. So we're doing pretty good there. And then Realtor, I was thinking, does Realtor not have it? I thought one of these I didn't have it, but maybe I was just imagining that. Because, oh, yeah, no, this is the one that doesn't have it. So, but I mean, they had it up until recently, right? They just don't actually give you it when it's under, when it's listed. But if you look at these, okay, look, I mean, there's right in the right ballpark. So I'm not too worried about the valuation on this one. It seems like between the appraisal contingency and Zillow and Redfin and Realtor that we're pretty much at least in the right ballpark. We've looked at a lot of these that I felt like we're overpaying. That doesn't seem to be the case here. It seems like we're really just paying the price for what the real estate should be worth, and then we're getting the operating business, the furniture, fixtures, and equipment on top of it. I think part of the reason for that, and let's go back to the AirDNA, is because there's a ton of short-term rentals in this area, and so I would bet that a lot of the properties that trade hands here those things are taken into account, right? And that, I'm like, that's probably a large driver of value in this market. Okay, well, let's get back. I was just looking at the FEMA flood map. This makes me really nervous, right? We're not just like at the edge of the AE zone. We're not like, okay, we're part of the properties in there. We're not in the shaded X. We are like fully in the, the AE flood zone. Obviously we're right on the water. And so just like we saw in the Stroudsburg, PA one, it's hard to not be in a flood zone and be right on the water. Sometimes you can do it, right? If you have a nice slope on your property or whatever it is, or a bigger piece of land that you're, a little bit further back. This is just something I'm just not comfortable with it, right? Like it is, obviously they're going to have flood insurance, and I trust the guys at Mogul to do that properly. Before I forget, please like and subscribe. In the description to this video, I have a link to all of the places where I'm currently investing in fractional real estate online, Mogul being one of them. But I want you to do your own due diligence on all of those platforms and on the properties themselves. Just because I tell you I like a property or I don't like it, or I trust this one or I don't trust it, that doesn't mean that should be the answer for you, right? You want to dig into all that yourself. Also, in the description of this video, I have a link set up to the Discord we talk about all different fractional real estate platforms on there. So please feel free to jump in there, jump into any of the conversations. Right now, Tim does have a link in there in the general channel asking for people's opinions. It's a survey about, what people are looking for in a fractional real estate investing platform. And so if you don't mind taking the time to fill that out, that would be fantastic. Anyway, back to this. I do trust that Mogul is, they're professionals, and I trust that they're handling the flood insurance properly. And if, or really when there's a flood, they're going to be on top of that. I mean, that's a big part of the, I have handled insurance claims in the past and I don't enjoy it. So it's why I've always avoided flood zones when doing my own investing, in whole properties in real life. I have relaxed that a little bit when investing in fractional real estate. But it is still, it's a risk I'm still not very comfortable with. And so if I loved this deal, if this deal was, was giving me fantastic returns and I didn't have any other complaints, I might live with this. But where this is supposed to be a core investment, right? Very stable, low risk. That's why I'm getting lower returns. To me, that doesn't match up with me being in a flood zone. So, this is something, they do. If you haven't signed up for Mogul's webinar that's coming out on Thursday, you should jump in there. And maybe this is a question we need to ask about, like to really define, like, okay, why do we think some of these things are core? Is this really lower risk than some of the other short-term rentals that we've got on there? Or are they just sort of putting them in the buckets based on the returns? I mean, that's what it looks more like is happening to me. Unless there's just some risks to some of them that I'm missing, right? I don't know. And I really want to go back and look at all that. And maybe I'm more hung up on this than I should be. But in general, I just want to look at that return and then think about all the things that could go wrong with the property. And am I getting properly compensated? And so this is a big one. And it's one, maybe it's not a big one for everybody, but in my mind, flood zone risk, it's one that I'm always worried about. So that's enough to say about that. Crime map. This is going back almost or over a month. And so it didn't come up with a whole bunch. There was a shooting, that's not right here where we are. Like if you look, it also gave us a pretty wide area, right? So if Sprott Crimes data is good in Largo, I feel like this is a pretty good looking crime map. Like, if you really zoom in to anywhere close to what we're talking about as our subdivision, all of a sudden there's hardly anything around, right? I also looked at the, what do we call this? The neighborhood scout crime map. And I think, this is where we are right here. Or is it? No, I think it's right here. And so you can see it is one of the least shaded areas. So very low crime relative to the rest of the area. Let's close that up. So far, so good, I think. I mean, the flood zone's the one thing that really makes me nervous here. But like, again, you're right on the water. They did mention this is a brand new, or a couple year old roof that is made for storms, which is a big deal in that area. I think they have hurricane windows as well, which I know that's important. Let's get this little guy going down here. Can't really see a whole lot from the street, but it is it seems to me that it's a pretty nice subdivision. Like I didn't see anything that I really wanted to complain about here. Although I don't know what that, why somebody was parked there, but that doesn't, I don't know. I don't think that's just an abandoned car. It didn't strike me as it the first time I saw it, but when I was just doing this now, kind of made me wonder. Anyway, not a whole lot of complaints from this. Let's jump into, okay. So I did find the short-term rental, this is the AirDNA info for this particular property. And so they said $219,800 in annual revenue last year, and that was only with 337 days available. So predicting 240,000. If we look at what Mogul is predicting for their year one revenue, and I know it's in the email as well, but I'm just going to go to, they're saying only 212, right? And so this is one where, and then it's not until year two that they're saying, okay, we're caught back up to what we actually did in the trailing 12. So this is one thing. Mogul seems to do this all the time, especially with their short-term rentals, try to come in very conservative. Now, obviously, if we have a recession, that number could go down. It might not continue to go up. We might have a dip before it comes back. But I think they're being as conservative as I would like to see, right? Especially because, again, this revenue was with 337 days available. Does that mean... It could mean that this property was offline for those other 30, around 30 days. It could mean that the owner was using it. It could mean it was rented on a platform that AirDNA doesn't pick up that info. Whatever it is, it makes me feel pretty good about these projections. Also looked at the reviews because I always want to see, what are people complaining about. This one did mention they only had a few negative reviews. 4.92 is really good out of 71. And I have noticed the more expensive a property is, the more people are going to complain about like little things. Well, I mean, that's not necessarily true because sometimes on the very budget end, you'll see a lot of complaints too. But I think people have high expectations of a property like this. And so to have so few negative reviews, either this manager is just doing an excellent job like dealing with guest complaints, or there's little to complain about. But this one did mention, okay, there's a water pressure problem. There's some, deferred maintenance with the property, broken. The fridge wasn't producing ice well. There was broken fishing rods, and then some, cleanliness issues and whatnot. So a lot of that is stuff that. And they responded and said, okay, we're trying to fix the water issue. But the rest of it is stuff that is more management, than it is the home itself. And so there's not, so there's nothing that worried me about the property there. And then, the other one, I think that, again, the only real complaint that was actually about the property is that the room with the pool table is close to the master bedroom, and so when people are playing there, it keeps them up. Well, okay, that's not ideal, but it's, I feel like that you're just kind of reaching there, right? I mean, there just wasn't really a whole lot. There wasn't anything in all of these that made me think, oh, we have a big problem we have to figure out, except for the water pressure. And like I said, they said they were looking into it. Hopefully that's something that's been addressed. Could be a question that we ask, if it hasn't been, but, if I were going to invest in this. This is interesting. This is listed as a 5-bedroom home here. Mogul has it as 4 bedrooms, 3 baths, right? And the listing says 5 bedrooms, 3 baths. So one of the things is often as a short-term rental, we can list rooms as a bedroom that we wouldn't if we had it listed for sale. And I think that number that's pulling the sale or the the number of bedrooms is usually pulling it from like sites like Zillow or something. So I'm curious if that's where the discrepancy comes from. But the AirDNA listing for this one, let's see, did show it as, how does it not even tell? Oh yeah, 5 bedrooms, 3 bathrooms, accommodate 16 guests. So I'm not really sure what's going on there. If you look at the map of these, it is the highest one nearby, at least that's showing up on the comps for it. So it's doing well compared to similar sized properties. There are some properties that are much larger, had like many more beds and baths, that had up to, I think, $500,000 in revenue was the highest one that I saw, and it was on one of these little peninsulas here, or whatever you want to call these things. So this is definitely on the high end, but it isn't, and actually, again, if we compare it to the average, like, we're very much above your average daily rate for the market, right? We're at $951 versus the $242. Just slightly above average in occupancy, but it's not the absolute top of the market. So I always think that's a good thing to not be the most expensive one. One, because it lets you know, like, okay, maybe there's some room for improvement here. Although they haven't really especially because they're saying it's a core investment. Well, it means it's like, okay, what we're buying is what, what we're expecting it to be. There's not some value add like, oh, we're going to change some things. But I do think it's good to see, like, okay, there's the possibility that we go even higher, right? Or there are, competing properties that are going for even more than ours. Okay, let's see. So that's really all I wanted to say about that. Let me close those. I already talked about that. I thought the current AirDNA listing, though, or Airbnb listing, is really good. I didn't have a lot of complaints about it. Sometimes, like, that's the easiest thing that you can do to improve your numbers is make a better listing, right? Don't even change the property itself, but actually, fix the marketing. It doesn't seem like there's a real opportunity to do that. We have, and like I said, I mean, even though there are some that are doing significantly better, the properties themselves, I think, are better. Let's see. We talked about Pinellas County, talked about Largo. I think that's really all I have to say about this one. So my only real thoughts are, okay, our yields are lower than I want, and we're in a flood zone. Other than that, I mean, it's a fantastic property, right? And it does look like they're sandbagging the yields a little bit, right? It looks like they're not projecting any growth, from last year to this year. And it looks like, based on last year's numbers, that it wasn't really a full year of availability. That's me making some assumptions based on the income that's available. I did want to look at how does this deal look without the refinance, because that's 11% and 11.4. So even lower. I mean, this is not a terrible deal. Like, if you go out, and this is one of the things I think that I've been really spoiled by Mogul in general. If you go out into your market and try to find a deal that's this good with this type of cash on cash return, especially with the reserves built in that they have and using a professional manager, you'll have a difficult time finding a deal with numbers this good. Excuse me. But I've just come to expect more from them. I've said that quite a few times lately, though. So it seems like their yields are coming down. I mean, we've seen some good some better ones, here and there, but it seems like their average deal may actually be trending lower. I'm not sure why that is. I don't know if it has to do with the fact that they're just bringing more deals onto the platform, so every single deal isn't going to be a home run. An 11.6% cash on cash return over the hold period, but really starting off year one is what? 7.7% cash on cash return. it's not a terrible cash on cash return, especially because it is, when they calculate this, it is they do roll into the fact that they raise a large reserve. I didn't go into the actual. This is, I know I'm all over the place. I'm sorry about that, but I didn't go into their comps that they used. I felt after just looking at the Zillow and all those numbers, and knowing that we got a little bit under asking price, and we have the appraisal contingency, I just feel good about the valuation. But obviously, that's something we can always do, is dig these up, and see. This is the type of market, or the type of area too, where it's very difficult to price things, because your proximity to the water and amenities, like in just the general opulence of the property. It's harder to comp some of these than it is when you just have cookie cutter subdivisions like we have in some other places. But even with that being said, I already felt good about this, so I didn't dig into those comps. If anybody has, I'm interested if you came up with anything different. Also, okay, we talked about the revenue. I felt really good about. Yeah, here, they just keep saying this is 4 bedrooms, so it is weird that the listing is for 5. But I think that they probably just have like some room that maybe it doesn't have a closet, but otherwise would be considered a bedroom, and so people are sleeping in there. Yeah, I mean, I like that. Not worried about the valuation. I like that it's a market. It's a very, it is a mature short-term rental market. People have been renting properties in this market short-term since before Airbnb existed, right? Like, this is just, it's a resort type area. It's a place where people have been going to vacation for a long period of time. I actually know plenty of people that make trips to this general area, not this specific city, but nearby cities for sure. So, that's good, established on that end. I don't really expect, a big upheaval in the rules for short-term rentals, because they've been dealing with it for a long time. Obviously that's always a risk with this business model, but I don't see it as being huge. I don't see a lot of things you could do to change this property, right? Like, it seems like it's well decorated. It has great amenities. There's not some large, outdoor space that isn't being utilized where you could add something. One of the things that I wondered about, because of the Alcaraz listing that Mogul has, where they are renting a boat and jet skis, like that, those are optional, like additional rentals. If they could do something like that here, curious if that's a possibility. They haven't mentioned it anywhere, so maybe it's not something that they want to get into, have any desire to do. But I thought that was, it made me wonder, is that something they could do here too, right? I mean, obviously they said they're providing fishing poles, so people can do that. But yeah, I mean, it is listed as core, so we don't expect there to be a lot of upside. But I'm always wondering that when I'm looking at, short-term rentals, because amenities are where all the action is there anything that we can add? And yeah, there's not a whole lot. They have the nice fire pit, they've got the pool, they've got the hot tub, they've got the dock and the water access, and lots of beds. They're accommodating 16 guests. The pool table, they even have this little popcorn machine. Some places you see like a little arcade room, like with some video games, but I don't really think they need to change much. I mean, they, as far as that goes, the revenue is really just a matter of, like, it looks like when looking at the comps that they're really getting, they're really maxing it out already. And so it's really just a matter of, okay, what the price is in that market to be able to achieve that. Anyway, that's my thoughts. This is another one. I'm probably not going to buy any of this one. If I didn't already have some of their short-term rentals, and if I really wanted to be in this market, well, that's the other thing I didn't mention. Florida scares me because of their insurance rates. I know a lot of investors that buy in Florida, and I mean, insurance rates have gone up all over the country. But there's a lot of people in Florida that think that they've just gone to the point where they're moving up so rapidly, that has scared them out of investing in Florida. Now, whether or not, it's not something I've looked into on this particular property. Obviously, I believe Mogul is getting a quote. It's one of the things that they do. They get insurance on all these. So it's something that they're going to look at, right? But for the future, like, is that a big risk that it's going to continue to move up rapidly? I think it could be. And so again, I mean, that eats into what is already a lower than average yield, lower than average for their platform, not for deals that, like, again, if you go out and try to find this deal in your market, you're going to struggle to find something that's good, I would guess, depending on where your market is, right? If you're in a market that, has highly desirable real estate, which is what this is, right? People want to move here. People are moving here. But for me, I mean, this is one I'm going to pass on it. I sort of, once I got to, I don't know how many properties I have now. Yeah, I have 16 properties. Once I passed like 10 or 12, I started getting a lot more selective. I want to just see how they operate for a while, understand how their business works and whatnot before, just really cherry pick is what I'm doing at the moment. I'm not putting a whole bunch of my money on here. I just, because I'm experimenting on a bunch of different platforms. And that's, I just like to remind people sometimes this is still very much an experiment. I'm not putting an amount of money on here that if I lost it on any of the sites, that it would, really hurt my chances of, really be a huge impact to my net worth, right? Like, I'm not, because there is still platform risk, right? These guys are all still figuring things out. There's, and that's one of the reasons why I want to be spread across multiple platforms. But, until I'm really comfortable, I'm not going to be, I'm just going to be cherry picking. I'm still just going to be sticking with like relatively small amounts that I'm putting on in each one, until, as I get more and more comfortable, I'm sure that will change. And as, if there are deals that come up that I just think are amazing, I'll probably buy more of them or more of that particular deal. And I think that that's, a prudent way to go about this. I already know that some people are just sort of YOLOing into every single one. On this particular platform, I don't think that's a terrible idea. These are professional real estate investors that are picking these properties. I think on average, I think their deals are much better than, for example, Lofty's or Arrived or most of the other platforms out there. I still think they're going to have some misses along the way, and I want to try to avoid those, right? Because the way we make money in real estate, it's a much different investing style than in stocks, right? In stocks, if you miss the couple of great winners, that's what really hurts your portfolio, right? Because, in real estate, if you pick up the big losers, because there's much more risk to the downside than the upside in real estate versus like the stock market. You can have a stock that goes 100x. You're never going to get 100x on your real estate, right? And so what we're trying to avoid is the large losses versus trying to just pick the ones with the best returns. And so that's why I'm really picky about, okay, what risks am I willing to accept and which ones won't I? I do want relatively broad diversification, right? Because I don't want to miss most of the winners either. But if you miss a couple of winners in real estate, it hurts you much less as long as you're also missing more of the losers, right? Does that make sense? Yeah, I think that's what I'm trying to say. Anyway, I did a really long video about this quite a while back. If you didn't watch that, I could find that, and I should probably put a link to it because I think it's an important concept, and it's one that I don't talk about all the time. But when you're creating your portfolio, it's much, real estate versus stocks is way different, the way that you approach it. And it's why I'm very risk averse, right? And why I'm just being picky and only buying. I'm trying to look at, okay, I think I bought a piece of the Malone is the last one that I bought a piece of. And then before that, it had been a little while. the Swift and the Gilmore and the Pinkman. And then before that, I was picking up a lot more. So I feel, for a while I was saying I buy probably 3 out of 4 or something. And then it dropped down to now. I mean, I've been passing on several, and I passed on the last 5, right? And you have to go all the way back here to get one that I bought, and then it was a couple, quite a few before that, before I had one. So I think it's a function of me being more picky, and it does seem like maybe they're stretching a little more to be able to put deals on the platform at a more rapid pace, right? Like if you're only doing one a month, it's a lot easier to find an amazing deal than as you start to try to get to one a week, and at some point in time probably they're going to surpass that. It just gets difficult to keep having just the absolute best deals. You just have to let a few more okay deals in, right? And if your goal is really wide diversification, well, I think that's maybe that's a good thing for us. And really it's a good thing because some of these are just selling out so fast. You just need the product available, right? Because I'd rather have a piece of the Gruden than no investment in real estate, right? Like I think that is, I'd rather have, I think their worst deal I'd rather have than, be not investing. So, I don't know. And really, I think I'd pick their worst deal on their platform probably over, the vast majority of the deals on Arrived or Arc7 or, I think that it is just their average is so much higher that it is, even though I'm avoiding some of their low end stuff or the stuff that I think is riskier or that I think is not as great of a risk adjusted return. It doesn't mean, I don't know. I think I've said that a bunch of different ways and then I just kind of trailed off and I'm going to be all done with that. So anyway, that's what I think about this. If you've got anything that, this is a late video for me. It's been out for, the property's been out for a few days. If you've come across stuff doing your own due diligence that you think other people might want to know, I'd love to hear about it. Please put it in the comments or jump in the Discord and let's have a discussion about it. Until next time, though, please tickle the like button and do the thing. There's the bell thing. But until next time, I'm going to just keep making mistakes so that you don't have to.